also rug pulls, signals commitment to the community, and the most important thing is smooth sell pressure so the market can absorb new supply. So this is the first reason why we need a token. The second one is what we call the network effect. So first thing, in order to understand what network effect is, I will take a real world example. Why you guys are using, for example, Facebook or Instagram? It's because all your friends are using it. If no one were using it, you are not incentivized, or you don't have find the utility to use it. So the more users are using this protocol, the more utility you have to use it. And this is also fundamental in every peer-to-peer protocol, because every new participant is a user and also part of the product or the infrastructures. For example, when I add liquidity to Uniswap, I improve the service for everyone else. That's what we call the positive externality, and it's the essence of the network effect. Utility per user rises with total users. We have different kind of users. Network effect. We have the direct network effects, which is basically bigger crowd gives better service. We have a two-sided network effect. Suppliers attract buyers and buyers attract suppliers. The money effect. We like to hold what everyone else accepts, like the dollar, for example. And the building block effect, which is using other protocols that have been built in your own protocol. But the key thing with the token is that it provides a solution to the cold start problem. Let's get back to our example and say you want to build a new Instagram. The key is to have a user base to incentivize other users to use your protocol. So when a brand new network opens its doors and it has 0 users, the token solution can give gifts. We call them airdrops to invite users to use your protocol, which would bootstrap your user base and make your protocol more better. We can also have loyalty bonuses, which offers bigger perks to those who stick around, similar to an airline miles that grow when you keep flying the same carrier. Shared upside, which is a system similar like dividends, which promise a slice of the future fees or profits that will be used to buy back or distribute more tokens. And of course, the most important one is the community voice, which lets the token holders vote on upgrades and budgets. Since we operate in a decentralized ecosystems, we usually have what we call DAOs, which are decentralized autonomous organizations, and these DAOs run with the tokens on every proposal and use these tokens to vote on the proposal. So the flywheel or the network effect in one sentence is free samples. It will bring the first crowd. So giving away free tokens will give you the first users. The service you are providing will improve with these first users. So more people will join and you will need less tokens to bring more people. The tokens becomes more valuable because your service is more valuable. Early users are rewarded and tell friends because the token is appreciating in terms of value, but also in terms of price. And the wheels spins faster and faster with less need of free tokens. And the key is getting the timing and the size of each incentive right to spark interest, but not printing too much tokens, or it will erode the value of the token, what we call inflation. And this is the whole art of tokenomics and incentive design. So now we've seen kind of what is tokenomics. Now we will dive deeper on the mechanisms and the tools we have in our disposition to design a token supply. So the first thing in a token supply is to define whether the token is has a fixed cap, has an inflation, is deflationary, how to buy back or burn token, and I've crafted this table that resumes basically all the policies we have, how it works, the economic intuition behind this mechanism, and when to use it, for which use case is it appropriate. So the first one is, I think, the most famous one, which is the policy of Bitcoin, which is a fixed and capped supply of, for example, 21 million for Bitcoin. How it works: minting stops at a hard limit. For example, for Bitcoin, it will be in 2141, I think. And the economic intuition is to mirror scarcity, like gold, for example. That's why Bitcoin is called the digital gold, and it would act as a store of value, censorship resistant collateral. The second one is also the most famous because it's also a mechanism or policy that has been implemented by Bitcoin, which is the geometric decay. The issuance drops by a set of percent every period. This is a way to print high inflation and then to have less inflation. And as we've seen in the previous slide, this is the best thing to do if you want to bootstrap a community. You would print a lot, give to the people a lot of tokens, so these people come to your ecosystem, and then as your protocol becomes better, you need less tokens and less tokens. So the early high inflation widens distribution. Later, the deflation tightens the supply, and this is used with proof of work or proof of stake based layer. We call them also layer ones that need big early subsidies, but they aim for long-term sound money. So they aim to be a store of value. We also have steady low inflation. For example, the ETH. New tokens are minted every New tokens are minted at a fixed percentage to pay validators. We can have burns. Burning tokens are removing tokens from the circulation, and this would reduce supply and make the tokens scarcer. So it would mechanically inflate the price of the token. So the good thing is about having a predictable inflation rate is it keeps money circulating, because if your token is deflationary, you're incentivizing people to hold it, because if people knows that the token would gain in value in 1 or 2 years, they won't be incentivized to spend it. So a small amount of inflation is a good incentive to incentivize people to spend their tokens and use it in your ecosystem. And that's what we want to do in the first stage. We want to bootstrap a community, we want to bootstrap a user base, so we need small inflation, not a lot, because it would create a vicious cycle. We will see that in the next slides, but a good amount of steady inflation is healthy for your protocol. The next one is the targeted and burns and buybacks. For example, the Binance token uses that. It has a quarterly burns. It burns part of the fees that has been uh, accumulated by the protocol, and it's a way to distribute or share the value of the protocol that has been created to the holders of the token, because by burning the tokens they become scarcer and the price goes up. It's also counter-cyclical. If we have a lot of activity, we would have a lot of fees, so we would burn more, which would act as a deflationary mechanism, which would lead to less activities. So it's also these policies are also a way to manage the inflation, deflation, and also the speculation. And we will see how these speculators can negatively impact your token. And the final one, which is still experimental, is the elastic rebase or more dynamic policies. They auto expand or contracts versus a target price. They seek a unit of account stability through supply and not a peg, but they are hard for users to reason about. So these are still experimental monetary, and the protocol that has used that failed, unfortunately. For example, Terra Classic or Ampleforth. And we can move to the next slide, which is kind of a recap and a summary of what we've seen. So if you have a protocol that mimics digital gold, you should use a hard cap plus geometric decay. If you have a protocol, and I think you guys would have that, a utility token used for gas or used to pay a service on a DApp, you would have a low steady inflation that would fund the security, and you can introduce burn a slice of fees to incentivize people to hold the token and um, incentivize loyalty and introduce this dividend-like mechanism. If you want to quick start your project and bootstrap it, like we've seen in the network effect slide, you would have high emissions with vestings, and you can introduce also voted escrow tokens logs. We are going to see that later. This is a great way to bootstrap your liquidity without permanent dilution. You can also introduce ongoing revenue share with buyback and burn or fee to dividends pool. Part of your revenue will be distributed to the token holders or the stakers of the tokens. It mirrors the stock buybacks or the dividends, like I've said. And of course, the most important is the decentralized governance, whether it is with the vote escrow VE or a linear community voting and vesting, and it ensures that the loudest voice can really have an impact in your ecosystem. So, in summary, inflation isn't evil, but uncontrolled inflation is. Small predictable rate can incentivize your users to spend the token and not hold it. Double digits inflation erodes trust, make price decrease. Deflation creates FOMO and hoarding, and this is useful if you want a token that has a store of value, but it can be risky for tokens you actually need to spend. And as we have seen also, if your token is used to buy the service, if the token price rise, the service rise because you are paying this service with the token. Vestings should be designed very carefully because the selling pressure from a vesting can erode the value of the token, and you can of course mix and match these mechanisms to design your own mechanism for the protocol. You can use buyback and burn with a fixed cap, with a max supply token. So this is where the economics and game theory side, and of course the community psychology meet the tokenomics, and this is kind of the art or heart of token engineering. So now we are we will dive deeper on the different blocks that compose a token and what are the components that are needed to have a token. So first thing, when you talk about token emission and staking, we actually need to separate two different layers. The base layer and what we call layer 1, and the application layer, what we call dApps, that lives on top of the base layer. They share the same vocabulary, but the incentives they manage are not the same. And I guess most of you guys are going to build dApps, so we will focus more on the dApp layer, but we will just introduce lightly the layer 1 staking and block rewards. So at the chain level, new coins are minted or existing ones are locked to buy security. Whether it is for proof of work chains, for example, Bitcoin, it pays miners a block subsidy, and this incentivizes people to mine and give hash power to secure the network. Later halvings taper that subsidy as transaction fees grows. The same mechanism is also used for proof of stake chains. It pays validators instead of miners. You lock ETH, for example, it helps validate the blocks and you earn newly issued ETH plus tips from the transaction. And you can have also hybrid designs, which combines proof of work and proof of stakes, like Stacks, for example, which is a layer 2 on Bitcoin. And now we will talk about the DApp level. So the DApp level stakings has two distinct jobs. A DApp cannot change the chain's consensus. So its token serves a different purpose. The first one is the dividend-like staking functionality. It shares the earnings or the cash flow that has been generated by the protocol. You lock the token and you receive a stream of protocol fees, very much like owning dividend or paying shares. The lockup reward users who add long-term value rather than fleeting volume. It also concentrates governance votes in the hand of those who have genuine economic interest and throttles circulating supply, which can underpin price if volume keeps growing. So, in corporate term, we are turning active customers into shareholders, employees who now cheer rather than dread the fee generation, which is a superpower in the token economics. So, now we will dive in the vesting design and how to design a good vesting and assess whether a vesting is good or not. So whether the token's job is guarding the chain or sharing dApp's cash flow, a sudden flood of unlocks can swarm price and get incentives. That's why the next design frontier after emissions is the vesting and release mechanics, the timeable that decides when insiders or early investors and liquidity farmers actually receive their coins. And if we get that schedule wrong, even the best crafted staking model will creak. And if you get it right and the economic flywheel has a chance to spin indefinitely, basically. So these are the tools that we have at our disposition to craft and design vesting schedule. The first one is the cliff. It stops insiders from dumping since day one. The good practice is to have a cliff between 6 and 12 months for the team, 3 and 6 months for the strategic investors. Then we have linear unlocks. It smooths the sell pressure. Instead of having all the tokens at a single day, we would divide these release over 24 months or 84 months. Then we have what we call event-based vestings, which are performance-based or milestone-based. It can be aligned with shipping product or hitting revenue or even reaching different milestones of TVL, for example. The good thing is that it is clear, verifiable, and since everything is stored on chain, we can verify pretty much everything. And we have the community lockups, the voting escrow or VE style. Users lock their tokens, get a synthetic version of these tokens called VE token, and they use these. So as I was saying, we can use incentives for staking rewards also, for cementing loyalty and security. So we have seen liquidity mining is about market depth, staking rewards are about skin in the game. So whether it is for layer 1 staking or dApp staking, we can use incentives to incentivize people to buy your token, lock them, and receive rewards. For the layer 1 staking, you pay newly emitted coins. For the dApp staking, it resembles more a dividend. Lock the tokens and receive a cut from trading fees or revenue that has been generated. And the effect should be loyalty. So people should be incentivized to buy your token as more revenue is generated, and also hold them because they are.
Yusuf,
Ge-
sorry for
yeah.
disturbing you again. So, someone is asking, can you please switch your slides into presentation mode? Okay,
Yes.
thank you very much.
Is it good?
Yeah, it's good.
Okay.
Thanks.
So how the incentives tie back to the flywheel I presented and the network effect. So this seed is the liquidity mining. It drops the initial free samples, letting early trades clear smoothly and the user experience be better. Then we have lower slippage, lower volume. People starts to lock in token to stake to get the revenues that the protocol is generating. And once the fees pay for security and dividends, emission fall because you need less and less emission to attract users, and the sell pressure eases, whether it is from the vesting or from your incentive schedule. And the key is to be able to design how much incentive do you need, and how long would you need these incentives. The key question now is how to do that, how to quantify how much incentive do I need, how to timely incentivize people, how to know how long would I need to incentivize people before my protocol can become self-sustainable. And that's where the token engineering disciplines comes. So now we will describe the transition between tokenomics and token engineering. And what we have just done right now is show the recipe book of token design, whether it is supply caps, reward rates, vesting curves, staking yields, liquidity incentives, etc. And on paper, these recipes look elegant, but crypto history is littered with projects that followed sensible formulas and still imploded the moment real users arrived. Whether it was in 2020 with the liquidation spiral of MakerDAO or the 2022 Terra Luna deathloop, in every case, the economic logic seemed plausible until a combination of events, whether it is price swings, human behaviors, or bad feedback loops, pushed the system outside of its comfort zone. And once that boundary was crossed, there was no central switch protocol. The contracts are immutable, and that's the hardest part in the Web3 is that everything is immutable. If you design something and you put it on the blockchain, you don't have a switch. You can't change something if something goes bad. In contrast with Web2, for example, Web2 teams can hot patch a server or roll back a faulty release within minutes. Central banks can also hold emergency meetings. They can change the interest rates, the collateral windows, or different parameters. But a blockchain protocol by design has no administrator who can intervene without triggering governance drama or breaking the trust model of the protocol. So upgrading live contracts can take weeks of voting or even months, also audits and migration scripts, and sometimes it's impossible. This hard reality means that we must train token design the way engineers treat a jet engine, simulate the turbulence before the passengers are on board. So this means you need to simulate complex agent interactions, agents simulations that would simulate agents buying and selling and using your protocol. A single liquidity mining pool can attract arbitrage bot, for example, that creates sudden and amplifying feedback between price and supply. You must take into considerations a bunch of technical parameters like latency and oracles, users' rationality also, will user panic, forget to sign transaction, or act on memes, and we because we cannot rely on patch as you go. The only responsible path is to model, stress test, and fuzz every economic parameter upfront. And that's exactly what the emerging field of token engineering tries to do. It blends economics, system dynamics, and software simulation so you can answer questions like what happens if volatility triples while half of the liquidity providers exit at once? How many blocks can an oracle freeze before the insurance pool is wiped? Or does my incentive schedule is appropriate for my vesting schedule? Um, and by turning those what ifs into executable simulations long before a single mainnet deployment, token engineering gives us confidence that these incentives will uh, be resilient and sustainable over time. So, in a single phrase, tokenomics tells you what incentive you want. Token engineering proves you whether those incentives will still behave when the market goes crazy. And now we will try to explain the workflow of token engineering. And the first step is the concept and economic brief. So the goal is to nail down why the token exists and what behaviors it must elicit. So key questions to ask yourself. So what user problems that does the protocol solve? How does the value flow among users, treasury, and token holders? Which incentives are non-negotiable? Deliverables can be one pager with mission statement and value flow diagram. It can be checklist of hard constraints. For example, the inflation should be lower than 3% after 2 years. And of course, the pitfalls are you should not design a token just to have a token, or you should not have vague objectives like community engagement with no real metrics. And an example of the goal is, for example, we are building a DEX for long tail assets. Success means deep liquidity on thin coins. We can stomach 15% inflation in year one, but we must converge below 3% by year three. And a 20% fee share will fund an insurance backstop and our operations. This is the way to lay down the core objective of your protocol and also have hard constraints that will be validated in your simulations. And of course, this is an iterative process. By that, I mean that if the simulations tell you that this is not sustainable, you should revise your goals and objectives. So the second thing is the systems mapping. Make every balance, flow, and feedback loop explicit before any code is written. By that we mean whether you have token mints and burns, whether we have cash flows, fees that goes into a certain pool, different state change that triggers a certain flow, or feedback loops. You should be able to visualize these by causal loop diagrams, whether you use a tool like Vensim or a basic stock to flow diagram. And this is very important. One of the key things to your success is to be able to visualize these. And the pitfalls is you should not also forget the time delays, for example, the vesting cliffs or the oracle lag, treating average user like a single user. Don't take into consideration that we have different archetypes of users like whales, bots, and this is an example of a causal diagram of Uniswap with different users and how the value flows around the ecosystem. The third workflow step is the formal specification, and this is where the coding part enters. So here we have our system design. What we will try to do is code this system into a simulation. So we would have the environment, so the block time step, the gas cost, whether you are DAP, the Oracle frequency, the price feed, etc. You can use CatCat, which is a framework that has been developed by token engineers for token engineers. You can also simulate contracts, whether you code them in Python or use directly the output or historical data of contracts. And of course, you need to simulate the agents, the people that are going to act into your ecosystems. You can use custom Python classes or frameworks like Mesa agents. And then we would move to the scenario and the what if questions. So you would define um, nominal scenarios, the day-to-day use under expected demand and volatility, and also edge cases, which we call them stress testing. You put your system under stress to see whether your system is going to behave, uh, to see whether your system is going to break or not. And this is the most important part. You need to be able to model rare but plausible operational stresses and see whether your system works under these conditions or not. And the final part is the Monte Carlo and parameter sweeps, which is to try to quantify the robustness across thousands of futures, not a single handpicked path. You would do random sampling, draw volatility, random behavior probabilities for your agents, run thousands of simulation and see the output of your protocol. You can use the parameter sweep if you don't know how much incentive you should use. For example, define different range of incentive size or different range of fee percentage and try to see how the agents would behave over each different parameter to see which one is the best. And of course, the robustness criterion, you should be able to define guardrails and count for the percentage of simulation that were successful. And this concludes the presentation. So thank you everyone for staying with me. And now we will try to pull the whole story together. So over the last 15 minutes, we cracked open the recipe book of token design, whether it is supply caps, create digital scarcity, reward rates that pay for security, vesting curves that turn insiders into long-term allies, or staking yields and liquidity incentives. All of that is tokenomics, the deliberate craft of wiring incentives so that thousands of strangers acting in their own self-interest accidentally do what's best for the protocol. But design on paper means nothing if it snaps the real time, if it snaps the first time real users tag on it. So remember, in blockchain, code is law. Once your contracts are immutable, patching them is slow, political, or outright impossible. That's why in the crypto space has evolved a second discipline, which is token engineering, the rigorous process of proving that your beautiful incentivized schema still behaves when the market crash, bots are inside your ecosystem, or the oracle breaks. A token engineer work like an aerospace engineer, they build digital twins, simulate turbulence, and only commit to the output. They don't trust, they verify. The workflow is straightforward but non-negotiable. Concept brief, system map, formal specification, scenario library, and Monte Carlo sweeps. And based on the results, you should iterate to have the best result. And in one sentence, tokenomics writes the rule of the game, token engineering makes sure the game can be broken. And that's why the two must live together. I will close here. Tokenomics show you what you build, token engineering show you whether it will survive. A small call to action is for you guys for the hackathon to start with a clear incentive hypothesis. What behavior must the token nudge, saving, trading, providing compute, what service your protocol is providing, sketch the feedback loops. Even hand-drawn diagram forces you to see hidden cycles, good or bad, and start with prototyping, even a tiny simulation. You don't need a PhD. You can use ad hoc notebooks, code it in Python or use CatCat. Model a token pool through Asian types, price feed, run it 10 times random shocks, and start iterating over that. Thanks for listening, and now we can move to the question part, or if you have ideas you would like to dig into next.
Yeah, thank you very much, Yusuf, for this brilliant presentation. And thank you all for your attention and time today. So I hope this session has given you a clear overview about token engineering. More importantly, if it has sparked your curiosity about tokenomics. At this point, as Yusuf said, I'd like to open the floor for any questions, thoughts, or feedback you may have. So whether it's something you'd like to clarify or a broader discussion about tokenomics, I'd be happy to continue this conversation. So please, if you have any question, you can drop them into the training stage chat. So we're waiting. I think earlier Yassine had a question. So while waiting for your questions, guys, I want to remind you that DAR blockchain is offering a free Hedera certificate that will prepare you to participate to this hackathon. So maybe, I mean, if you can drop the link of this certificate in the chat.
Okay,
All right,
I
so
already
we have a
see three
question.
questions. So the first
Yeah,
one is where we use tokens and what is that? So as I said, a token is like a stock and a fiat currency at the same time. You buy an iPhone with the Apple share, and why do we use it? It's a way to raise funds with the ICO, and it's also a way to bootstrap your community in case you need network effect. So if you don't need network effect, if you don't need fundraising, you don't need a token. Basically, that's it. Usually, if you are working on a blockchain, you are working on a peer-to-peer system, and something inherent in a peer-to-peer system is the network effect. So if you are on blockchain, you need network effect. So you would need incentives to bootstrap your ecosystem, your protocol, and make your service better. So you would need a token. So the second question is whether having a fixed token supply or a flexible one, which one is the better. So it depends on, first of all, it depends on your use case. If your token is a store of value, then you should have a fixed or a capped supply. If your token is a utility token where people must spend their tokens, then you should have in inflation, a steady inflation. You could have a fixed supply with inflation, but the state of the art right now is to have a maximum or an infinite max supply in inflation, but add also a burn mechanism in order to have leverage or to a way to stabilize this inflation if it starts printing too much. Because as we've said, a small inflation incentivizes people to spend their token, but a lot of inflation destroys your economy and ecosystem. So you should have inflation, but also a way to reduce that inflation by burning or by backing your tokens. Usually it's part of the fees that have been generated in your ecosystem. This ties the token supply with the profitability and usefulness of your protocol. So as more fees and revenue are generated on your ecosystem, the more tokens are burned, more scarce your token is and the token price appreciates. So Web3 Papi, token engineering is basically simulating your policies that you've created, whether they are the vesting schedules, your incentives, and the users' behaviors to see whether you are converging towards your objective, whether you are profitable or not, whether you have enough users to absorb the inflation you are releasing, and how long would you need an incentive schedules, or how much also would you need incentive to be able to sustain an activity for 10,000 or 100,000 thousands of users. Yes, there is data about total supply and circulating supply of tokenomics. You can see tokenomics.ai for the vesting release. I will share with you all the data providers. So these data providers gives the data for the vestings for basically a lot of protocols. You can also use June Analytics, which is a tool for on-chain data analytics. You can create queries to see how much revenue protocol is generating or how people are behaving, and we usually use this data to, we call it calibrate our models to have models that are data driven and behave the most um, be the most realistic possible by calibrating them with real data. So for investors, I guess the most important thing is utility, whether you are solving a real problem or not. Then they would see your vesting schedule, how much inflation you would have, your business model, whether you are generating fees with transaction fees, or you are selling bundles or NFTs, how your business model is, and your model of your projected revenue, how much are you able to generate revenue. We also usually try to model the token price under different scenarios. If you have 10,000 users, how would your token price behave with the inflation you have? So these are the key metrics the investors need. So for burning or vesting, it's all code. So no one is managing this. It's coded in the smart contracts. And that's why this discipline is also difficult. It's that it's coded and it's immutable. So once you've done it, you can change it, or it's very difficult to change it because you would need to go to the DAO, have the vote, and it would take a lot of time. So all of that is coded in the smart contract. How much you are going to burn, how much tokens are going to be released to the investors. All these are coded in the smart contract. So I think there is no more questions. Feel free to ask your questions.
So, for those who are asking where they can find the recording. I shared with you the link of our YouTube channel, so you'll find it there. And we have another question now for you, Yusuf. What is the relationship between tokenomics and real world assets?
Yeah, so uh, one of the most important thing in real world assets is the liquidity, because you are wrapping an asset in the real world into the digital space. But you need to have enough liquidity in order to have smooth trades. So the key thing for this is to incentivize people to provide liquidity on the liquidity pools in order to have smooth user experience and not have a high slippage. And this is something I've presented here. You need to be able to incentivize people, put tokens for free so they can provide liquidity, and then the more trading volume you have, the more fees you will have, and the less incentives you would need in order to have a smooth user experience for trading.
Right, I think there are no more questions, and we've already spent more than 1 hour. So before we wrap up, I'd like to thank you, Yusuf, first, and thank everyone who has joined us today. So your engagement and questions have been fantastic. I want to emphasize that this is just the beginning of this program, and we'll have additional sessions in the coming weeks for other tracks such as AI, decentralized physical infrastructure, and other tracks that are in the hackathon. So on each session, we'll dive deeper into different aspects and we'll also include practical applications. So I encourage you to keep joining this stage each Friday at 4 p.m. UTC plus one. And that's it, guys. Thank you again, and I look forward to continuing this learning journey with you. Thank you very much, and see you next week. Goodbye.
Bye bye. Thank you, guys.